Let's welcome our market expert for the morning, Dheeraj Agarwal, an independent market expert, now joins in. Good morning, Dheeraj.
Good morning.
Well, I'm just battling with this stock market, which is continuing to be cheerful, and day after day of earnings, which are continuing to disappoint. Do you think the markets have run way ahead, and that after the budget, there is a bigger chance of disappointment?
I think the risk is quite high. So, typically, market gives some time to any new government, new regime, new environment to take place. Market always tries to discount the future. By definition, it will move ahead of the fundamentals, either improving or deteriorating. So that's what is happening. Liquidity scenario has been excellent. Domestic mutual funds are getting inflows every month, 9 consecutive months, which I think is a record. $8 or $9 billion as per what I read in the papers. And the FIs continue to pour money. So that's keeping the market up. But at some point of time, the ground level economy has to show improvement because it's still not improving. In fact, if you see the last quarter results, it looks like things have probably worsened a little bit at the margin as compared to 2 quarters ago. And that's a risk, which is why I think this budget becomes very, very critical.
Do you think there is a very big danger of both current year's earnings and next year's earnings getting downgraded at the end of day after tomorrow?
I don't think people will react on earnings numbers after the budget. But I'll tell you what my view is, what the economy needs from the budget. More than big bang reform statements or big bang, we will do this and we will do that. The market at this point of needs some public spending. Because historically, if you analyze the investment cycle of any country in any cycle in any part of the decade or year, the initial flip always comes from government spending, and the private investors follows the government investing. And I worry a little bit about this government's obsession with fiscal deficit numbers and keeping the rating agencies happy. I think we need to loosen the purse strings just a little bit. It doesn't require to completely let go, but you need some government spending to create the feel good that yes, money is being spent, jobs are being created, investment cycle is restarted, and then you'll see a flurry of private investments happen.
So let us assume if the deficit announced is not 3.6 but say 3.8 or 4%, you think the markets will not react negatively?
No,
will in fact react positively?
I think so. And obviously the market will analyze where the additional money is going. If it's going into revenue expenditure, it's a waste. But if it's going into capital expenditure, it will be taken positive.
So a higher fiscal deficit and a lower revenue deficit will be taken positive?
Yes.
Okay. In one of your earlier answers, you indicated that, there is a risk for the markets to correct post the budget. In case there is a status quo budget, they adhere to all the fiscal deficit targets and it's slow on public spending. How steep could the correction be from here on? And what will it take for the market rally to continue?
I think if the budget disappoints, I think we break 8,000 support. And if we break 8,000 support, we'll be looking at 7,500 odd, which is the next key sort of congestion level for the market in the last 8-9 months. And if you broadly see this market post-elections, it's been in a range. So the first 3 months or 4 months of the new government, the range was more like 75 to 8,500. The last 2 or 3 months, the range looks more like 8,000 to 9,000. So the whole range has shifted vertically upwards by just 500 points. And if you also see the returns post the euphoric market rise just around the election time, it's not really much. If I remember right, on the election day itself, the market touched about 77 or 7,800 or something like that, or within a couple of weeks after that. And today we are at 86 odd, so it's not even 10%. So it's a weak post-election rally from that point of view. Most of the rally actually happened pre-elections in the hope of elections. So stocks and sectors have gone all over the place. Few stocks and sectors have done well, few have done badly. But at the index level, that euphoria is not there.
So the advice for an investor at this point in time is to not rush in, that there is a very good chance you will get better levels after the budget?
I think so. And in case the budget does deliver, then one can be looking at breaking the upper end of the range, which is 9,000. If that happens, we're looking at 10,000 at 10,500. So even if you're slightly late, I think there is still a lot of money to be made. But if I think budget disappoints, the downside will be deep this time.
Okay, so let's work with both the scenarios. In case the budget disappoints and the market does fall, say, to levels closer to 8,000, then in such a scenario, which would be the stocks and sectors investors should pile on? Because perhaps then, we're not going to be getting that capital spending, and maybe infrastructure would not be such a great idea. So then, in case the budget disappoints, which would be the sectors and stocks to watch? And in case it delivers, then your recommendations.
I think in either cases, one sector which continues to look good to me is IT.
Okay.
Whether the budget is good or bad. And the IT view is largely predicated on the fact that the US economy is doing really well. So there I think business continues to come in at a steady pace. Also keep in mind the kind of valuations sectors and stocks are getting in this cycle for similar amount of growth is much larger than the previous cycle. So my favorite example in that context is always Hindustan Unilever, which is trading at roughly 36, 37 times 1 year forward earnings, with a 13% earnings CAGR. Levers used to trade at 40 times PE multiples in 90s, with a 30% earnings CAGR.
Okay.
So if you put IT in that context, I think with the US economy looking rock solid, 15, 17, 16, 18% earnings CAGR is there for the taking. So that sector, to answer your question, in either case will do well. But what to buy if there is a sharp correction is, I would still go with investment names. So I will still go with banks and infrastructure, because there's always the fight between short term and the long term, right? So if the budget disappoints, I think short term it's negative. But what this government is doing is all positive for the long term. So they are creating a very solid administrative backbone for execution. And that itself, I think, over the longer period of time, can add 100 to 150 basis points to GDP growth. So the whole discussion around budget is, purely from a trading point of view.
Yes.
What happens in the next 3 months or next 4 months?
Absolutely.
Yeah.
Governments are there for all 365 days.
I think for the next 3 years, India is in a very solid wicket. I'm very bullish on the economy. I'm very bullish on all the longer term stuff the government is doing.
Okay.
So that's your long term bet.
Now, how much are you pricing in by way of rate cuts? And if that fiscal deficit number is not 3.6 but 4, then the imminent rate cut one is expecting in March or April perhaps gets postponed.
I think the impact of rate cut on the economy at this point of time is slightly overstated, which is what the RBI governor has also mentioned a number of times, and I completely agree with him. It is more a financial market obsession rather than the real scenario at this point of time.
And therefore it is a one-day play.
Yeah, it's just a 1 day or 3 day play. Will another 2 rate cuts revive the investment cycle in the economy? Answer is no. You need public spending to revive the investment cycle. So once public spending revives the investment cycle, private sector comes in, then the government focuses back on fiscal consolidation, then the rate cut happens. We are in a fantastic situation. But you can keep on cutting rates, but investment cycle, look at the world. 2/3 of the world is at a 0 interest rate. Is investment cycle reviving anywhere? Answer is no.
So as an investor or as even a trader, a scenario of higher fiscal deficit and no rate cut in March or April is a better situation for you.
The economy needs to revive.
No. I'm just asking. As an investor, you would look at it as positive.
It is. The most crucial thing for the economy and the sustenance of market at this point of time is I.
Okay, investment.
Yeah.
Have you worked out any numbers or any goalposts for us to assess the budget in terms of, public spending or what the potential fiscal deficit could be and what would be okay for next year?
No, I don't have any specific numbers in mind, but purely a guidance from the government that the government will be spending more on infrastructure development, whichever area it is, and not be so obsessed on cutting expenditure and focusing on fiscal. Most of the fiscal deficit reduction of the last few years have been achieved through reduction in expenditure. And we saw the impact of that on the investment cycle in the previous fiscal year. So Mr. Chidambaram delivered very well on the fiscal deficit side, but the huge reduction of public expenditure suddenly took the economy down to 5%, 4.5% GDP growth. So it has to be delta. So the public expenditure next year, I'm looking for a 20-30% jump over the previous year. So
when you say financials, which kind of stocks do you mean? Do you mean only private banks? And when you say infrastructure, what do you mean? Only L&T?
No, I think financials will be both. Longer term, I think even government banks should do well as the economy revives. But if the investment cycle takes longer to revive, the government banks will take longer to come back because they need some push for growth, whereas private sector banks have managed their book really well. So they are okay by and large. On the infrastructure side, I would look for less leveraged companies, basically. When the high leverage companies have an issue.
Okay.
So that's the broad categorization I would.
All right. Dheeraj, pleasure speaking with you as always. Thank you very much for joining us.
Thank you, Lata. It was nice coming here.